Meantime, major averages pacing for another week of gains, led by tech. The S&P 500 back above 6K for the first time since February. Joining us this morning at Post 9, David Kelly's back, JPMorgan Asset Management Chief Global Strategist. Some pointing out, David, the jobs number, the unrounded unemployment number has risen every month this year.
Well, that's right. This was a lot softer than the headline suggested. I mean, to me, that's one issue, is that we saw over 600,000 jobs lost, according to the household survey. That's very volatile, but that was a negative signal. The other thing is cutting 95,000 out of the prior 2 months. So we've only averaged 124,000 jobs so far this year per month, over the first 5 months of the year. It's 168,000 last year. And, when I'm looking at a lot of data which shows this sort of slowdown that is gradually seeping up and spreading across the economy, and I think we're missing it because we're looking at headline payroll numbers or the weirdness in terms of trade and GDP. But this economy is gradually slowing down here.
Where do we think payrolls bottom out in the second half? Are you in the sort of 80 to 85 range?
At the moment, I think that it'll be somewhere close to 100,000 jobs as an average going forward. But it could bounce negative.
Right.
And in general, and even that is, I think the unemployment rate won't go up much because we're seeing some constraint in terms of immigration. But it's just a slower economy. This is a 1.5% economy. This is not a 3% economy.
So Trump's right. Fed should be cutting.
No, I think Jay Powell is right that he can't cut right now because you've got immigration, which is pushing up wages. The wages were strong this morning. And because you don't have enough labor supply, that's going to push up wages a bit. You've also got tariffs, and that has not fed through to inflation yet, but it will. We expect to see 3% year-over-year consumption deflator by July.
But the Fed can't do anything about tariffs or immigration. That's not the kind of inflation that they are used to fighting. And if you're saying there's moderation, and they're restrictive, doesn't it just make it worse?
Well, first of all, I think they're only a little restrictive, but two wrongs don't make a right. The Fed has got a responsibility to control inflation. And remember, we've also got this fiscal package, which is stimulative early on. You're going to have a big bounce in the budget deficit in 2026, which is pure sugar. Now, if that bill turns out to be, if it doesn't pass, or more likely, if it gets toned down a little bit, then maybe the Fed can think then. But they really need to see, is the rest of Washington, is the other side of Washington going to tone it down in terms of causing inflation for the Fed to actually feel comfortable there? So I think they're right to wait and see.
So what underlies your 1.5% GDP prediction?
Well, because so far this century, the economy has grown at a 2% rate. And that has come from 1.5% productivity growth and 0.5% employment growth. The problem is that right now we're seeing not just unauthorized immigration, but we're seeing legal immigration fall. In April, legal immigration fell by 16% in terms of authorized visas year over year. And if you take away that extra employment, and you don't have any employment growth because you don't have growth in the labor force, then you're back to a 1.5% economy.
What about productivity increases as a result of AI?
We just had productivity disappoint.
Well, productivity will long-term increase because of AI. But even there, you need to do capital spending, and you need to do continual innovation. We need to be the leaders in AI. We need to continue to be the leaders in AI. And, I think there are, I'm in favor of deregulation in some areas to try to speed things along. But there are a lot of things that are causing businesses to hesitate to invest rather than to go full bore ahead in terms of investing right now.
Right.